Hi, I'm Dan Reese, and as promised, we're going to continue with our videos to help you cope with this crazy market environment we're in, the coronavirus, all the things going on, and all the uncertainty that's really in existence today. So what we really want to focus on are things and information that's going to allow you to have some more peace of mind around your money, your portfolio strategy, and really the knowledge that if you do what you're supposed to do, like we talked about yesterday, really being disciplined and patient and consistent through times like this, good things will happen and you will reap the rewards over time. So today, what I want to start out with is really the question of the day. And so a pretty consistent question that I've gotten the last couple of days with people that have called in that I've spoke with has to do with portfolio recovery time. So the question is I understand I'm doing what's right, I'm staying disciplined and being patient, even though it's hard. But what my real question is how long does it typically take for a portfolio to recover? And am I going to be alive to see it? Which obviously that's a little bit tongue-in-cheek, but legitimate question because it's something that people wonder about. So we're going to take some time today and we're going to go through some couple different scenarios that are not in too far the distant past. One, 2008 financial crisis and how portfolios reacted during that. And then also 9/11, which is a little further back, but also kind of an important comparison because it was more of an event-driven decline in the market versus a recessionary decline, where 2008 was obviously the banking crisis and everything that caused a lot of other problems. So what I want to do is I want to start out with, and we're going to take a look at where we are today, right? So this is a chart from through yesterday in the market. And what it shows you is a couple of things. The blue line is the S&P 500, and what it shows is year to date through yesterday was down about 21%, right? The green line represents kind of a balanced 60% stock, 40% bond portfolio with worldwide diversification in both the fixed income and the stock positions. You can see that's also down about 18.8%. So both down, right, there's that's the S&P, both down pretty good for the year, right? So no fun for anybody to go through, fully understand that. But we just wanted to give you a benchmark of where we are right now. So let's take a look. We're going to go look at a date that everybody probably remembers, and that is this is October of 2007 through September 30th, 2012. So before we go into that, I just want to give you a little reason why we're looking at that. One of the things that is good to understand is a question like, hey, if I was a really, really bad investor and picked one of the worst days I could to begin investing, what would have happened, right? So this is a great time period because if you look October 2007, that's actually when the market started going down, proceeded to go down through 2008 into 2009. So we've got a good picture of what would have happened if we would have done what Avery Welt's talking about. If we would have stayed disciplined, did what we were supposed to do, how would that have looked? So let's go back to that screen and take a look. So what you'll notice is starting at 0% right here, right? And this was that big drawdown, right? And so you can see the comparison. The green, again, is the balanced portfolio. The blue is the S&P 500 or the U.S. stock market, right? So everybody remembers how much it went down, and it was pretty darn painful, right, as you saw that. But what I want you to focus on is this 0% line. So you see how as it goes across, where did we get back to normal, right? And so you can kind of see it on the screen here, the diversified portfolio that has the balanced approach with the fixed income in it actually weathered that storm quite a bit better, right? And we'll show you the actual days there. But you can see right around March of the following year, so the date that it ended was March 8th was the bottom, right? Down here. So this is where the bottom was. And then how long did it take to get back to even once we hit the bottom? And so believe it or not, it's only about just over a year for the balanced portfolio. Obviously longer for the all stock portfolio because it's more aggressive. But this is a really good thing to look at. So the next thing is how much money did I make if I just sat on that portfolio for 5 years? So remember, I started at the worst time I could. It just started dropping right away when I invested. How long did I have to stay disciplined to really make any money? What this shows is a 5-year holding period, and you can see the balanced portfolio actually ended up with about a 20% gain. So if you look at that a little differently, what that shows you is, let me get to this other screen, your $100,000 actually grew all the way to $120,000, right? So you did actually decent through a really, really bad market. All you had to do was stay disciplined, shut off the news, and leave it alone. Rebalance like we talked about yesterday. The S&P 500 didn't do as well because obviously it was more aggressive, so it went down more. There's no fixed income there. And you still made money, though. You're up to $105,000. I would venture to say if you were in the bank, this definitely beat the bank. The S&P 500 is probably pretty similar to what the bank would have been through that period of time, right? Next thing I want to look at are what are called our stats on the portfolio. So this is important because what this is going to show us is the total return over that 5-year period, right? 20, just what we just looked at, and 5.37. Then it's going to look at the max drawdown. So this is really important because people think, how bad could it get? Well, in 2008, if you look right here, we actually, even on a balanced portfolio, got down almost basically 38%, right? That was a maximum drawdown through the period. If you're in the S&P 500, that number was actually about 55%, right? That's how much it went down. Sometimes we forget the severity of the downturns, but that was pretty significant. And then, so this down here shows a little more information. It says, how long did it take? So it took about, for the balanced portfolio, about 495 days from start to finish, right? So we're thinking year and a half or so to get from top to bottom. Then how many days did it take to recover? So this is kind of what the question of the day is about. And you can see it took 393 days to recover. So just over a year, right? About 13 months to fully recover from that downturn. Now, if you were more aggressive and were in all stock like S&P 500, it took quite a bit longer, right? You're up to about 1,120 days. That's where that diversification and some of that balance really helps out. So I hope that's helpful on that part. Now, I want to go look at one other thing. Number one thing I want to look at is to show you what happens a lot of times. This represents the down period. So 2008, this is the calendar year. The S&P was down 37. The balance was down about 22. Then look what happens, though, and this is pretty common. The next few years, you had really good returns, 25, 15, 11 had some government shutdown. There's some things that went on, so it was pretty flat. And then another 10 to 15, depending on how aggressive you were after that. So that's a pretty good thing to look at. Okay, so that was the Great Recession, right? So you can kind of see it went down. It got down quite a bit more than we are today. And once things got a little better, the market recovered very quickly. Matter of fact, that balanced portfolio, about 13 months based on those charts we just looked at. So let's look at the next one we're going to check out. And what I want to look at next is really the 9/11, which was a different situation, not near as severe. But let's go ahead and change these dates. And so the same thing we're going to look at what if we held it for 5 years. So we are, again, not a great investor. We picked a time where the market immediately went down, right? And so what happened then? And this is really interesting because if you look across this 5-year holding period, it really wasn't down long. And this because it's an event-driven market situation, not necessarily a recession that caused the market to go down. So you got that quick downturn, and then it really started to recover really quickly. Then we had a more downturn and so on. But keep in mind that, again, diversification and balance helps. So you really reduce the downturn quite a bit by having a diversified portfolio versus just the S&P 500. And over time, what happened through this 5-year period, we actually grew about 62%, even though you started on one of the worst days you could have started on, by holding it 5 years. And the S&P was still up about 30, even though that had a lot more volatility in things. What's that mean as far as how much your money grew? So again, if we started with that $100,000 right here, by the end of that 5 years, look at these numbers. Your diversified portfolio was up to $162,000 in 5 years, and your S&P was at 129. So you got a really pretty good return through that period, even though we went through a pretty bad market event. Let's take a look at those stats again, so get our real numbers around that. So in the diversified portfolio, we had a drawdown of about 14% through that period of time, compared to about 33 on the S&P. It went down for about 143 days, right? So we had a few months there that it went down. The S&P actually went down for about 204, and it took about 231 days to recover. See that? So less than a year, obviously, quite a bit less than a year, and we had all our money back. So if we look at one other thing as far as the period returns, you get another idea here. That year, even though 9/11 hit, we actually only ended up in a diversified portfolio down about 4.7 compared to 22 in the S&P. But then after that, you see the good returns that followed, right? So, the moral of the story here, let me get back here to my video. The moral of the story here is the person that tuned out the noise and really stayed disciplined through those different types of market events had a really good investing experience and actually made money, got their return or get recovered quite quickly from the downside. But you can't do that if you give in to all the hype and you sell out and you go to cash. Because here's the reality. If you go to cash, you don't get that rebound. And the rebound tends to happen really, really quickly. And if you miss those few days in the market, like we talked about yesterday, you lose your whole return. So our goal really is to stay disciplined, stay with your program, and stay with your financial plan so that you can have a great amount of success. And keep in mind that question of the day, how long will it take for my portfolio to recover, I hope was answered. And as we move forward, keep the questions coming in. We're going to do our best to answer those each day. And I hope you have a great rest of your day. Thanks so much.